Hello and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. Often when we share information about the economy, we talk about the U.S. consumer and their financial health, or corporations and their revenue and profitability growth. Today I'd like to spend a few minutes talking about the U.S. government, which is a third part of our economy and also a large portion of our economy. I'm going to give you context of some of the numbers related to the U.S. government. First, there is 3 million people employed by the federal government. And when you add in state and local municipalities, that number grows to over 22 million people working for government entities. Our total workforce is 161 million, so it represents about 13% of all employees. Clearly meaningful numbers. Now, when we talk about the U.S. government specifically and its expenditures, this year's budget is expected to be about $6.5 trillion. Our economy is $28 trillion, so it's equal to about 23% of GDP, so clearly a large number. Now, what's interesting about that number of $6.5 trillion is we're only generating about $4.9 trillion of revenue, so we get a budget deficit of about $1.6 trillion this year, which gets added on to the nearly $34 trillion of national debt that we have today. All those numbers are big and clearly need to be part of the decision-making process when we look at investment opportunities going forward. Now, I'm going to pick on a couple of topics, one related to the stock market, one related to interest rates and the U.S. government. Our first graphic comes from the Lutho Group, who is one of our independent research firms that we subscribe to. And if you look at the graphic, you can see the top portion is related to the federal deficit as a percentage of GDP, and the bottom is profit margins from corporations. Now, the really positive thing out of this slide is that profit margins for corporations have been growing for the better part of 25 years, which means ultimately we have higher stock prices. But what's also interesting is when you go to the top of the chart and see that every time we have a spike in the deficits, that tends to shrink profit margins. So the governments are essentially pushing out the corporate investment, which long-term is not a good situation for the U.S. economy. When we move to our second graphic, which is tied to interest rates, this really goes to the $34 trillion in debt that we have. In the graphic, you will see that just 4 years ago, the United States government was spending about $400 billion on interest. Today, that number will approach $1 trillion. So basically $600 billion more per year in interest expense, which just gets added onto that deficit I talked about earlier. Now, when you think of $600 billion, that's $50 billion a month that's going into the pocket of investors and savers and corporations, particularly banks, which invest in treasuries, and to be honest, foreign governments who have invested in the United States Treasury and our debt. So $600 billion is equal to about 2% of our GDP, as I mentioned earlier, at $28 trillion. Clearly, whether it's a million, a billion, or a trillion, the United States government is an important part of the U.S. economy and something we need to consider when we're making investment decisions. If you like the content of today's video, I encourage you to share that with your friends and family. And if you do not regularly receive the market share, I encourage you to subscribe with the QR code at the end of the video. And as always, thank you for the opportunity to serve you and your family, and have a great day.